The estimated second quarter gross domestic product, GDP, data released on Thursday shows the U.S. economy teetering on the edge of recession, with an overall inflation-adjusted GDP decline of 0.2%. If we do get a full-blown recession, it will be tied to the sharp declines in housing and residential investment, which fell by 14% in the quarter. The Fed's rapid series of interest rate increases has been its most aggressive in nearly 3 decades, and they are hitting housing especially hard, pushing up mortgage rates and disqualifying many potential buyers. Rates on 30-year mortgages have risen from 3.22% in early January to 5.3% in late July, adding hundreds of dollars to homebuyers' monthly payments. Builders see the decline in qualified buyers and in turn stop building. Rising interest rates also hurt builders directly, as they increase the costs of borrowing money for construction. The National Association of Home Builders reports that confidence among builders of single-family homes fell to its lowest levels in 2 years, seeing the largest single-month drop ever in their confidence index except for the start of the COVID-19 pandemic. That lack of builder confidence shows up in falling permits for new single-family housing, which fell by 8% in June to the lowest level in 2 years. The result: residential fixed investment, RFI, fell in the second quarter by 14%, a very sharp decline and around a quarter of the total decline in gross private fixed domestic investment. Investment in multifamily and manufactured housing, part of RFI, also fell. This may seem like bad news to many of us, but it is what the Federal Reserve wants, inducing a sharp economic slowdown and perhaps a recession in order to control overall inflation. Many economists are pushing back against the Fed's actions, saying that a recession is more harmful than current levels of inflation, especially since inflation doesn't seem to be driven by wages. We may not get a full-blown recession. Economist Robin Brooks of the Institute of International Finance tweeted that the U.S. is not in recession. He said housing is in meltdown, but private consumption growth is on the pre-COVID-19 trend. Economist Claudia Sahm cites research showing that although lower-income families suffer from inflation, there is more harm to them from job losses, with the adverse effects of higher unemployment lasting for years. And job losses are felt more strongly among men, Black, and Hispanic workers,